Well, we think it's a great idea for Australian investors to diversify away from the Australian market. So buying companies in the US or in Japan or in Europe or in emerging markets, it's a great way to manage risk in your portfolio. The problem is that to invest overseas, you need to get exposure to foreign currencies, to the US dollar, to the yen, to the euro, and so on. So diversifying is a great thing to do, but you can't do it without, at least initially, having exposure to foreign currencies. So it's something you need to be aware of. The thing about currencies is they can make you a lot of money and they can also lose you a lot of money, and it's quite difficult to tell which. During the financial crisis, for example, foreign currency exposure at one point was a fantastic source of returns as the Australian dollar came under extreme pressure. But then foreign currency exposure proved to be a source of losses when the Australian dollar strengthened. So every time the Australian dollar comes under pressure, you make money by owning foreign currencies. But every time the Australian dollar strengthens, that costs you in return. And that's the risk that you need to be wary of and to manage when you invest overseas. If you're going to manage currencies directly, it's a complicated process involving forward foreign exchange contracts and settlements and so on. But there are now some tools that are really convenient to use. Historically, it's tended to be managed investment schemes that are unlisted, where you can buy a hedged version of a product compared to an unhedged product. But now there are even exchange-traded funds that have hedging built into the fund itself. So you can buy exchange-traded funds where the currency exposure is hedged, or exchange-traded funds where the currency exposure is unhedged. And in fact, you can very easily trade between those two to manage your foreign currency exposure on a day, or even if you want to, on an intraday basis. A short-term currency hedging strategy involves a lot of turnover. And the first thing we would suggest on short-term strategies is don't chew up all of your gains from transaction costs. If you're going to have a short-term strategy, be very clear about when you are going to trade and when you're not going to trade. That's one of the reasons we like long-term strategies. Typically, even long-term strategies, we tend to be slow to move them. If you trace every 2-cent move in the Australian dollar, you'll be trading 3 times a week. So wait for there to be a significant shift in currency levels and then take your time getting your new position set. We launched a hedged international equities ETF a few years ago, at the same time as we launched an unhedged ETF. And we did that because we thought the currency environment was such that investors would want to take an active role in their level of foreign currency exposure. So it was important to have both vehicles available. Moving between those two vehicles, the hedged and the unhedged, is very easy to do on the exchange. Both funds will track on a minute-by-minute basis what's happening in global equity markets as well as global currency markets. Furthermore, the hedged ETF can be used to adjust your total currency exposure. So if you have a high dividend ETF or you have a REITs ETF, you can use the hedged ETF to get the total exposure just right.